Recording is started, so this is lecture number 7, lecture 7, chapter 9. Chapter 9 is about budgeting. Budgeting, it's a very important thing, very practical thing. Let's start and see how it goes. So the first thing, budget. What's the budget? Budget usually is detailed, quantitative. Quantitative, that means full of numbers, plan. So basically the budget is a plan expressed by numbers for how you're going to get and how you're going to use the financial and other resources for the some period which is in the future. Now the act of the preparing budget is called budgeting, obviously, and the use of the budget to control the organizational activity is known as a budgetary control. So again, the budget is a plan with numbers of how you're going to get and how you're going to use financial and other resources. Right? The budget can be done for the inventory, it can be done for anything else which has numbers, or can be done for the money. From where you're going to get, how you're going to use them. So you have two things. You have planning and you have a control. Now the planning involves developing. You have on the plan stage, you develop objectives, and you prepare various budgets to achieve those objectives. Again, you have to understand, if you don't have a goal and if you don't know where you're going to end up going nowhere. You have to understand this. So if you want to go from where you are to some other point, you have to first find that point. And then you have to prepare various budgets to achieve that objective. Now control means you involve steps which are taken by the managers, which will be you, which gonna ensure you that you're on the right track in order to get the objective that you set up on the first place. Remember, on the planning stage, you set up the objective and how to reach that objective. On the control stage, you're controlling yourself, say, where I am. On the road that I'm right now, can I get to where I want to be? Now, what's the advantages of having a budget? So for you, budget doesn't mean always anything with the financial stuff. It can be non-financial, as you can see. So anything that involves planning, controls, anything that involves getting resources and using resources can be called budget. So you have to define the goal and objectives the most. Then you have to coordinate the activities. Then the other advantage is the means of allocation of the resources. Also, communicate the plan, right? Once you have the plan, through the budget, you can communicate your plan, how you're trying to achieve that plan. You can think about the plan for the future. And the last thing is to uncover the potential bottlenecks or problems with the system or problem with the current process, which give you a trouble. Now, the managers should be held responsible only for the items that they can control to the significant existence. You cannot hold responsible people for the things that they cannot control. So what that means to you is when your wife does something and which is not in the best of your interest, and you start blaming her, ask yourself, does she have control over the items that you're holding her responsible? If she doesn't have a control, don't keep her responsible. Don't yell at her. And vice versa. So you understand, this is What I'm trying to say is here is this is for the managers, but at home you're the manager. Depends who you are. Are you the husband or the wife, or are you the kid? Who you are. So if you want to be fair, don't keep people responsible for the things that they don't have control over. How can we choose the budget? Budget usually it's you have two types of budgets: operating budget, and the other one is capital budget. Operating budget is within 1 year, or when you're looking forward for the next 12 months. 12 months, 1 year, whatever you want to say, 365 days, whatever you want to say. But that's your operating budget. Anything above 12 months, it's going to be called capital budget. Why? Because on the capital budget, you have a capitalization. Capitalization means that you extend it in the time. When it's extended in the time, from the pure financial perspective, you have to, and you're going to learn it in the finance course. But when the things go over 1 year, you have a perspective of the time value of the money. That's where the capital comes. The capital decision is something that it's going to give you benefits on the long term. Operation is just involving the current operation. Now, the continuous, you have two budgets. One can be continuous budget. The other one can be zero budget. Now, the continuous budget is the one that it's always for 12 months. What that means is when the month of March ends up, you're adding March at the end of the budget. So it's always going to run on the 12 months basis, right? You understand what I'm talking about? It can be on the monthly basis, it can be on the quarterly basis. So once one quarter ends up, you're adding the same quarter at the end of the budget. So it's continue. It doesn't stop. Who is responsible for preparing the budget? Well, you can have a participative budget, or you're just giving the budget to the people. Obviously, the better thing is to have a participative budget. Participative budget is prepared with full cooperation of all the participants in the company or in the chain inside the company, the value chain inside the company. Who will be that? No, obviously the supervisor is going to give you information to the manager. Middle management is going to give you information to the top manager. How it's going to work this? Basically, let's, for example, on the Center School of Management, they're going to ask the teachers what we need for the entire year, what kind of supplies, what kind of things you need to deliver the courses. So we're saying what we need. Then that information goes to the next manager. He combines that information from the older teachers and bring it to the next manager until they get the final numbers, and they say, okay, now we can have the budget. Advantages. Well, obviously, the individuals of all levels of the organizations are viewed as a member of the team. Again, don't forget this. If you want to have a strong company, try to keep people involved. Try to make them important. How are you going to make them important? By involving them in small activities, which are more like a high-level management activity. One of them is budget. Budget estimates prepared by the frontline managers is more accurate. Why? Because those people know what they're doing. They exactly involved in the process. Now, the people usually on the high level of the management, they're not involved in the day-to-day operations. Motivation. Okay, and it's another thing that you have to consider. Now, when you put people to participate in setting their own goals, that increases their motivation. Now, in the manager who was not able to meet the budget, they cannot claim that that wasn't realistic. Why? Because they prepared the budget. Right? That's another thing that you have to understand. Once you ask people to do their own budget, and after that, when they came and say, "Well, I cannot meet that budget because it was not realistic," well, who gave me the number? You're the one who suggested that number. Now, participative budget should be reviewed as a always have to be viewed by the high level of management. Why? Because they might be a budgetary slack. What budgetary slack means is that some of the managers, let's say sales manager, he perfectly know how much sales he can do on the best year, he can do on the worst year, if he working the company long enough. So what he can do is, expecting based on the expectations of the year, he can budget purposely lower sales. So once he reached that number, because now the sales, the budget that he set is lower, he can easily reach that sales number. And once exceed that number, he knows that I'm going to exceed this number anyway. Once exceed that number, he can go to the manager and say, you know what, you see the numbers now. I budget for that much, but now I'm selling more, so I need my bonus now. So that's why the top managers have to check the budgets to see if the lower management put some budgetary slack there. Budgetary committee is the one that responsible for the overall policy matters relating to the budget, coordinating the preparation of the budget, resolving the disputes, and approving the final budget. Now, what's the factors in the budget? In order to have success, you depends on the three factors. First, top managers must be enthusiastic and committed to the budget process. If you don't look at the budget for some good tool that can help you to bring yourself to the next level, then you're in trouble. Top manager must not use the budget to pressure the employees or blame them when something goes wrong. Right? Even though the thing's going wrong, you cannot always blame people. Blaming people is not going to help you. Highly achievable budget targets are usually preferred when the managers are reviewed based on the meeting of the budget targets. So basically, when you review the performance of the managers, set up the reviews for something that can be achieved. Because again, you want to motivate those people. You don't want to discourage them. Now, the zero budget, that's a tricky budget because that's always start from zero. Obviously, if you're doing every year zero budget, that will be too time consuming because basically you're ignoring everything that's happened and you start from zero. Means that you have to go back to the manufacturing, preparation of everything from the scratch. So that's why most managers argue that the zero budgeting is too time consuming and can be too costly on the annual basis. If you have to do it on the annual basis, that's too costly because it's a lot of work. It's a way easy when you're using the numbers from the previous year and you're just updating them to reflect the current situation. However, that being said, maybe in the company, if you're running your own company, of course, if you're running your own company, it might be advisable every 10 years, let's say every 10 years, you to do 1-0 budget. So you can see, go back to the basic and see how it is. On the budget, master budget is the one that included all the budgets. Master budget including, first, you have to understand everything starts with the sales. As you can see here, as I'm always telling you in this course, no one starts with the expenses. Everybody starts with the sales. Don't be like those entrepreneurs that open the company and always start with the expenses. They put in money, investing, and they don't even know how much they're going to sell. And 3 months later, they're out of the business. Stop being like that. Start with the sales. You cannot spend money if you don't have the money. From expenses, incurring expenses, nothing's gonna come. There's one song that says, nothing come from nothing. If you do nothing, don't expect something to happen. Nothing comes from nothing. So the first thing that you have to do is to budget yourselves. Once you budget yourselves, then you can see, do I have the inventory to achieve that sales? So once you achieve the inventory to do that sales, then you have to produce that inventory. Then you start the production. But don't produce the products and after that thinking, who should I buy this product? That's a normal, stupid thinking of the people. Let's do this. Okay. Who's going to buy it? Well, it doesn't matter, but it's a good idea. It's a good idea, but who's going to buy it? So again, always start with the sales. Start with the sales, then plan the inventory that's going to achieve that sales. Once you plan the inventory that's going to achieve that sales, then you're going to do the production. And as we already know from the production, product costs are three product costs: direct material, direct labor, manufacturing overhead. That's why you have to prepare budget for direct material, for direct labor, for the manufacturing overhead. Once you do that, then you're going to go with the fixed expenses, which are selling administrative expenses. Then you're going to prepare the cash budget. Then you're going to prepare the income statement and the budgeted balance sheet. So how this is going to work? Let's start one after another. For this part, I'm going to switch to Excel spreadsheet, and we're going to start working on the Excel spreadsheet. Okay? Everybody comfortable?
Yes.
All right. So the first budget is this company, or our company, prepare budget for this. So I'm going to copy this and I'm going to flip it to Excel spreadsheet. Then we're going to move to Excel spreadsheet. Can you see my Excel spreadsheet?
Yes.
All right. So what we have here? We have the sales. We have to prepare the budget. Preparing budget for the quarter ending June 30. They have budget sales for the next 5 months are 20,000 in April, 50,000 in May, 30,000 in June. Then we go end of the quarter. Then we have July, August. Correct? Can you see my screen?
Yes.
All right. So what we have to do? We have to put the numbers, and the selling price is $10 per unit. So can we calculate the total sales for April? Obviously, that will be the budgeted sales times the selling price. Correct? And that's our total sales for May. Then we're going to, for April, then we're going to get total sales for May. Then we're going to get total sales for June. Then we're going to calculate the total sales for the quarter. We can do it this way or that way. And the total sales for August will be August, obviously the sales price is 10. We can do the 10, and for July and for August, we can do the same thing, and we can calculate all those numbers from July, August, correct?
Yeah.
Anything scary on preparing of the total sales budget? There shouldn't be anything scary. Now let's
Oh,
go
yeah.
back to the slides. So what we do? Individual month, April, May, June. We're preparing the sales, 20, 50, 30, $10 per unit price we get in sales. Now, the question is, so we did the sales. Now we have to collect the money. You understand, by doing the sales, it doesn't mean that you have the money. Now we have to collect the money. How are we going to collect the money? Collecting the money by this pattern. So again, I'm going to copy this one and I'm going to move to the Excel spreadsheet. Can you see my screen? Now all the sales are on account. What that means? We're not having any cash. Anything is on account. So everything is on accounts receivables. Now this company collect the following part. 70% are collected in the month of sale. So whatever we sell in April, 70% we collected in April. 25% of those $200,000 I collected in May, and 5% we never collected. Now the March 31st accounts receivable balance was $30,000 and will be collected in full. So if we want to prepare a budget for the sales, how are we going to start? Obviously, the first thing will be $30,000 we collecting in. Let's clear those numbers first, so you can see the idea how the whole idea is done. So in first, we're going to collect in April. First thing that we're going to collect is the $30,000 from March, correct? Now in April, we're going to collect the 70% of the sales in April, and the 25% we're going to collect in May, correct? So here we're going to have the sales from April times the 70%. And that will be our collection in April. That's how much we're going to collect in April. Now the 25% of the sales in April, we're going to collect them in May. So that will be equal to this number times the 25%. Make sense? So now the May, what's going to happen? In May, we're going to collect the 70%. Sorry. I'm not sure. Here we're going to have 70% and 25%. So in May, I'm going to collect the 500,000, but only 70% of those. And the rest 25, I'm going to collect it in June. So for May, I'm only going to collect the 25 in April and 70% of the May sales. So that will be my collection for May. For June, what's going to happen? I'm going to collect first the 25% from May. And after that, I'm going to collect the 70% of the June sales, correct? That will be this one. Here we have to put number 70%. And the next 25, I'm going to collect them in July, correct? Are you with me, people?
Yes.
All right. So for the quarter, I'm going to collect $905,000. So now you can see my sales are 1 million, but I'm going to collect only $905,000. Make sense?
Okay, so you're not taking into consideration the 25% that you took on July, right?
What do you mean?
Calculating the quarter.
Well, oh, for the quarter?
Yeah.
Do I have to do it?
No, I'm just asking.
No, but I'm asking you. Am I collecting those 25% from June? Am I collecting them in June?
No. Okay,
No.
so it's going to just add for the next quarter. Okay.
Right. That will be in July. So what will be $75,000 at the end of the quarter, what will be that? What that will be represent? That will represent my outstanding accounts receivables. Make sense?
Okay. Yes.
So here you see in March 31st, accounts receivable balance was 30. Now the question is, on June 30th, what was the accounts receivables? Well, 75. Why 75? Because that represents 25% of the sales in June. Make sense?
Yes.
Good. So that's with the, let's go back to slides now. See how the slides go. So for, again, collection, so we start preparing this. So we're doing all those things. Now the question is, what will be the total cash collection for the quarter? We already calculate that number. What was the number? D. Right? How are we going to get it? That's how we put cash is prepared. Now we prepared, so far we prepared the sales budget. We prepared the collection budget. What's the next thing that we have to do? We start going with the production. Now, so once we have the sales, now we can see, do we have those products available? So first, for that, we need more information. The management of this company wants the ending inventory to be equal to 20% of the following month budget sales. And in March 31st, 4,000 were on hand. Now we have to prepare the production budget. So I'm going to copy this, and we're going to move to the Excel spreadsheet again. So again, management of the company wants the ending inventory, to be equal to 20% of the following month budgeted sales. On March 31st, $4,000 were on hand, no, 4,000 units were on hand. Preparation budget. So obviously, the starting point, we need the sales, correct? Are you with me, people?
Yes. Still here.
So the starting point is the sales. Now, these guys, they want the ending inventory balance to be equal to 20% of the following month's sales. So what will be the ending inventory for me in April? It will be equal to the sales of May times 20%, correct?
Yeah, 10,000.
10,000. Why do I need those $10,000 to stay at the end of April? Why do I need inventory at the beginning of May? Can somebody tell me? Anyone? Are you guys thinking, or what's going on?
Yeah, thinking, but I don't know, because you need to have inventory to sell, I guess. I don't know.
Of course you need the inventory to sell. Of course, in the May 1st, if you don't have on the April 30th, if you sold all your inventory on May 1st, 6 o'clock in the morning, what you gonna sell?
Yeah.
When the first customer comes on May 1st at 6 o'clock in the morning, and if you sell everything on April 30th, what you gonna sell on May 1st at 6 o'clock in the morning? Or what you're going to say to the customer, you know what, I don't have anything right now, but if you come around May 5th, already going to have a product. And what he's going to, is he going to come on May 5th? He's not going
Probably
to
not.
wait.
Probably not.
Probably not, because he's going to find it somewhere else. Why does he need to wait for 5 days? Because you didn't predict. The other thing is, listen to this. For the ending inventory, you can look at it as a cash as well. Do you need to have a cash in your bank account on the end of the month?
Of course.
Of course. So can you drain down your account to zero on by the end of the month? Technically you can, but you still need to have some money to start the month, right?
Yeah.
So that's your budget. So that's why you need the ending inventory here, because you want to start. So the total that you need. So in that case, I need to predict. I need how many units I need. I need the one that I'm going to sell in April, plus I need 20% of my sales in May. So the total I need is 30,000. But I already have 4,000, correct? I already have 4,000. So let's say 4,000. So how many I need to produce? I only need in April, I need to produce only 26. Because with the 4,000 that I have, that's going to give me 30,000 units. 30,000 units, from the 30,000 units, I'm going to sell 20,000 in April, and the 10,000, I'm going to sell them in May. So what's going to happen in May? In May, I will need the 10%, 20% of June sales. So in total, I need to produce, I need totally I need 256. But I already have beginning inventory. How much is my beginning inventory in May? Who's going to tell me?
Give me a second. I'm going to.
How much is my beginning inventory in May?
It will be the same 10,000.
Same 10,000. So in other words, what's the beginning inventory for May? The ending inventory for April. Make sense?
Yes.
When you open your bank account, the balance at the end of the April, on April 30th, is the balance on the May 1st, correct?
Yes.
Do you understand the logic?
Yeah.
Once you check your account, at 11:59 on April 30th, you can see that you have, let's say you have in your bank account $1,000. At 0.01 on May 1st, you're still going to have $1,000 in your account, correct? So that means the ending balance for April is the beginning balance for May. What's the difference? The difference is actually 2 minutes from one to another, but it just happened to be the end of the month. Same thing here. On April 30th, whatever you have on April 30th, that's what you have on May 1st. At the end of the day, April 1st is that what you have on the beginning of May 1st. So next one. On June, what's my desired ending inventory? How much I need? I need 20%.
20,000.
Of the 25,000, correct? Which I'm going to sell in July.
Oh, oops. Yeah, it's not
Not for the
20,000.
quarter. Not for the quarter. I need the one that I'm selling in July, right? So I need only 5,000. So in total,
Yeah, 5,000.
I need 35,000. But I already have beginning balance from end of the May, correct? And that's beginning balance is equal to this $6,000 here. Make sense?
Yep.
All right, so in this case, let's see for July. What's happened in July? How much I need in July? And in July, I need 20% of the
3,000.
3,000. So in total, I need 28. But I already have 5,000 from June, so I need to produce only 23. So let's see now for the quarter. My sales are budgeted 200,000 units. Now the quarter, what month the quarter starts? What's the starting month for the quarter?
April.
April. So what's the beginning? What's the desired ending inventory? So what's the desired okay, the quarter starts in April, and when the quarter ends?
June.
June. So what is my ending inventory at the end of the quarter?
June, which is
June.
5,000.
So that will be 5,000. Good. So for the quarter, I need to put total I need is 105, but I have a beginning balance. What's the beginning balance for the quarter now?
10,000.
4,000.
4,000. Make sense?
Oh yeah, it was
Because
really in the ending. Yeah.
The beginning balance is for the quarter is the beginning balance in the first month of the quarter, which is in this case, so 4,000 is my beginning balance. So in this quarter, I need totally to produce 101 units. In order to sell during the quarter 100,000 and to have a ending inventory, I need to produce that many units. So if I produce that many units, I'm going to have 5,000 balance, and I'm going to sell 100,000. Make sense? Does this make sense?
Yeah.
All right. So let's go back to the slides then. So again, we start with the sale. Yes.
It's normal to use invoice in quarters or trimesters?
Quarters. Trimester will be the same as a quarter. So that's why it will be the proper way to say quarter.
Okay, thank you.
Right. In here in North America, they go in quarters. They're not going trimesters. But it's exactly the same. It's just different. It's just called quarters. Right? So that's what we get in the ending inventory for March. That's how we getting the desired ending inventory for April. And the ending inventory for March become beginning of inventory of April. So the question is, what's the required production for May? So in order to answer this question, let's go back to the Excel spreadsheet and let's see for the May. What's the required production for May? Can you see it?
Yeah, 46.
46,000. Let's go back to the slides. And let's see if that's the answer. So the answer should be B, right? Let's see, B. So how are we going to get it? That's how we're going to get. We're going to get the sales from May. We're going to add the desired ending inventory, which is 20% of the June sales. Total that we need. Less the beginning inventory for May, which is the ending inventory for April. And we're going to get 46. And that's how we're going to prepare the production budget. Don't forget, for the quarter, when you get the numbers for the quarter, the ending inventory for the quarter is the ending inventory from the last month of the quarter, and beginning inventory for the quarter is the beginning inventory for the first month of the quarter. if you calculate those 1, 2, 3, it's not going to work because you're working for the quarter or trimester. Now production budget is done. So now we know how much we need to produce. Now the question is, do we have materials? Do we have labors? Do we have overhead? So now we have to start preparing our budget first for the direct material, second for direct labor, and third for the manufacturer. Let's go with the direct material. Direct materials. This is the information. So I'm going to copy this information. I'm going to move to the Excel spreadsheet. Just give me a second. All right, I'm ready. Let's go. So this is the information. This company, 5 pounds of material are required to produce 1 unit. Now, the management wants material on hand at the end of the month to be equal to 10% of the following month production. Again, we don't want to end up without material. So that's why we need, at the end of the month, at least 10% of the next month production. 13,000 pounds of material were on hand at the end of March. Material cost us 40 cents per pound. So what we have to do? We have to prepare budget for direct material. First, our starting point is the units that we need to produce, correct? Once I know the units that I need to produce, now I can start managing and preparing my budget for the material that I need to buy to produce those units. So, in order to produce 26,000 units in April, how many pounds material I need? How many pounds I need for one product?
5.
5. So when I put here 5, so how much product, how much I need?
130,000.
Now 26 times 5, correct? 130. So I can do the same thing for May, I can do the same thing for June, I can do the same thing for the quarter, and I can do the same thing for July, correct?
Yes.
Are you okay? So now, that's the material, production material needs. So now I need the ending inventory, correct? What's my desired ending inventory in April? %10 of
May.
materials on hand in May. So 10% of whatever I do in May. So in that case, how many pounds material I need?
22,000.
How about in June? In June, I need 145,000 times 10%. How about that's in May? How about in June? In June, I need 10% of July production, July material, correct? So that's how I'm going to get my desired ending inventory. So at the end of June, my desired ending inventory is 11,500. Let's get rid of it. Now, total needs. Total needs, obviously, I can easily get those, huh? That's what I totally need. Let's start now. Less the beginning inventory. What's my beginning inventory for April? Obviously, that will be the ending inventory in March, which is 13,000. So how much material I need to purchase if it's 140,000 pounds. When I purchase 140,000 pounds of material, I would be able to produce 26,000 units. Make sense? Are you with me, people?
Yeah.
Yes, Professor. It's okay.
Okay. So, May, I have total needs. What's my beginning balance for May? For the materials, direct material.
140.
Again, what's my beginning balance for May? That will be the ending balance for April, correct? My beginning balance for May is the ending balance for April, correct?
Yeah.
So how much is my beginning? How much is the ending balance for April?
Is it the 23,000? Yes, I think
It is.
it's that one. Okay.
Let's put it ending inventory. Let's put it this way. So now you can see it. These are ending inventory. So that will be the 23,000. How much is my beginning balance for June?
14,500.
Which is the ending balance for May, correct?
Yep.
So now let's prepare for the quarter. In the quarter, my production is that much. So when I use 5 pounds, I need that much material. What's my ending balance for the quarter?
11,500.
Which is the ending balance for June, correct?
Yeah.
How much is my beginning balance of the quarter?
13,000.
Which is the beginning balance for April. Excellent. So how much is going to cost me this material? Obviously, for every pound, I have to pay 40 cents. So my cost, total cost for April will be that much material that I have to buy time 40 cents. It's going to give me 56,000. And if I want to transfer this formula, it's going to be like this. And now I can transfer this formula all the way to here. That's how much it's going to cost me. Make sense?
Yes.
Okay. So now I have the cost for the material. So it's going to cost me $56,000 to buy 140,000 pounds material, with which 145,000 pounds material, I'm going to produce 26,000 units. And from those 26,000 units, I'm going to have 20,000 units sell in April, and I'm going to have $10,000 units available inventory for the beginning of May. Make sense? So now you can see how we're going through the numbers to get the right picture. Now let's go to slides again. So again, we're doing this. We're starting with the production. Production is our starting point. Then we're adding the pounds. Then we get the production need. Then we're adding the desired ending inventory. Ending inventory is 10% of the next month required material. Deducting the beginning balance, which is the ending balance from the previous month, and we come up with the material that we need to purchase for that particular month. Now the question is, how much material should be purchased in May? Let's go back to the Excel spreadsheet and we'll see what's the answer here. So how much material we should purchase in May?
221,000.
500. Okay, let's see if that's the answer. Do we have this as answer? Yes. That should be A, right? Let's see if that's correct.
Yeah.
So yeah, that's the answer. So again, getting the May production, number of pounds per unit, total that we need. Add the desired ending inventory, which is 10% of the next month material that we need. Get the total needs. Deduct the ending balance for the inventory, which is the beginning balance is the ending balance from the previous month, and you're going to get the material need to be purchased. Now let's move one step further. Let's see cash expectations. Oral pays 40 cents per pound for the material. We already said one half of the month purchases are paid in the month of purchase. The other half is paid on the following month. I'm going to copy this and move to the Excel spreadsheet again, and let's prepare that budget. Does it help when we're doing those budgets together or just looking on the slides? Which one you prefer?
I find it way more useful to do it together. Just helps to understand the whole process of it.
Okay, let's do that then. So we have the cost per pound, right? We know the material purchase. So let's do this. So first, once we have the cost per pound, actually I can flip this one right here on the top. I can copy this and put it here. But now I have to put it as values. It's not going to work that way. Let's put it this way. And then I want this number to be. And there. Okay, so from this point, let's see what are my expectations. I'm paying 40 cents per pound. We already applied this 40 cents per pound. One half of the month purchase are paid in the month of the purchase. The other half is paid on the following month. The March 31st accounts payable balance is 12,000. When are we going to pay this 12,000? Which month? We're going to pay the ending balance in March. In which month we're going to pay the ending balance for March?
In April.
In April. So let's start with the payment of the April. So after that, we're going to pay 50% and 50% and 50% and 50% and 50% and 50%. Let's apply those percentages. So in April, what else are we going to pay?
50% of April's, which is
Of April's. Correct.
28.
28. How about in May?
Another 28.
Another 28, which will be equal to 50% of the April. So we pay the April, correct? Those
Yes.
28 and 28, it's exactly 56. So we already pay April. What else are we going to pay in May?
Half of May, which is what, 44,300.
That's correct. So when are we going to pay the other half of May?
June.
In June. That will be this one time 50%. What else are we going to pay in June?
Half of June.
Half of June. 56 times 50%. When are we going to pay the other half of June?
July.
In July. So what will be our accounts payable ending balance for June. How much will be our accounts payable ending balance of the quarter?
28,400.
Everybody understand this? Does it make sense to everybody? Okay, let's go back to slides. And let's see what the slide says. Start with the accounts payables. In April, we're going to pay first what we owed for March. And then we're going to start paying 50% of April. In May, we're going to pay the other 50% of April. The question is, what's the total cash disbursements for the quarter, for the entire quarter? How much we have to pay? So let's go back to the Excel spreadsheet and see what the Excel spreadsheet says. How much is for the quarter?
The 185.
185,000.
Okay, so let's go and try this answer to see if that's the correct answer. Sorry, I have to share my, not the Excel spreadsheet, I have to share the slides, right? So the right answer should be 185, correct?
Yeah.
Let's see if that's 185. How we gonna get it? That's how we're gonna get it. Just give me a second now, because I'm gonna stop this recording.